Well, welcome to session number 12 of Sharpen Your Edge, Learn to Trade Fearlessly. We are, of course, studying the complete guide to volume price analysis. Read the book and read the markets by Anna Calling. And we're not in chapter 2. Chapter 2 was why volume, and just review, all financial markets are manipulated in one way or another, and the only way to know whether a price move was genuine or false was by using volume. Volume cannot be hidden. It is there for everyone to see. So what is volume price analysis? Wait a minute. I'm sorry, I'm in the wrong section here. My apologies. Let me get up to where I'm supposed to be. There we go. Take 2. Welcome to Sharpen Your Edge, session 13, not 12, session 13 of Sharpen Your Edge. And we are studying a complete guide to volume price analysis by Anna Calling. Read the book and then read the market. We're in chapter 3, the right price. No price is too low for a bear, nor too high for a bull. No one knows who said that, but it was said about 100 years ago. Okay, so key concepts from last week's lesson is price on its own is just that. It's price. Volume on its own is just that. It's just volume. And it's really the combination of both price and volume together, and they become a powerful indicator of the future market activity. So we are in chapter 3 now, the right price. The counterbalance of volume is price. Volume price analysis, it's been around for about 100 years. The same is true when we consider the analysis of price. The only representation of price which has truly changed how traders studied and analyzed charts was the introduction of candlestick charts in the early 1990s. And Anna says in her book, whilst it is undoubtedly true to say price action encapsulates all the news, views, and decisions from traders and investors around the world, and that with detailed analysis, we can arrive at a conclusion of future market direction. Without volume, we have no way of validating the analysis of price. Volume gives us bearings. It allows us to triangulate the price action and to check the validity of our analysis. This is what the pit traders of old were doing. They would see the price move, they'd validate it by considering the order flow in the pit and act accordingly. Of course, for us, it's really the same. We simply use an electronic version of order flow, which is the volume on our screen. In a manipulated market, volume reveals the truth behind the price action. In a pure market, volume reveals the truth behind market sentiment and order flow. So let's take a closer look at price, and in particular, the effects that changes in technology have had on the 4 principal elements of a price bar, which are the open, the high, the low, and the close. And the most significant changes in the last few years has been the move to electronic trading, which we do every day, which has had the most profound effect on 2 of the 4 elements, namely the opening and closing price. So in this lesson, let's take a look at individual bars in more detail and the 4 elements which create it, namely the open, the high, the low, and the close, and the importance of these from a volume price analysis perspective. So we're going to dissect a typical candle and see how much we can learn from it today. In really any candle, there are not 2, not 4, but there's actually 7 key elements. It's really the open, the high, the low, and close, the upper and lower wicks, and the spread, as shown in this figure. Each of these elements plays a part in defining the price action within the time frame under consideration. It is the wicks and the spread which are the most revealing in terms of market sentiment and underlying price when validating volume. Now, we work in very, very short time frames. This really works best when over a number of bars, individual bars. It just moves too quickly for us to analyze individual bars. We really want to look at this over a longer time frame, like the 5-minute candlesticks, or even longer, even the 15 and 30-minute candlestick, to really get a more thorough understanding of how price action is moved. And this is bull. Okay. Now this graphic depicts the same price action as a sine wave. A wide spread between the open and the close indicates strong market sentiment, either bullish or bearish, depending on whether the closing price finished above the opening price or below it. A narrow spread between the open and the close indicates sentiment which is weak. There is no strong view one way or the other. This is the power of wicks, and why, when used in combination with the spread, reveals so much about true market sentiment. It forms the basis of price action trading. This is an upper wick example. We have a wick where the price is open. The market has moved higher, then moved lower to close back at the open. And let's look at this a little more closely. Upper wick example. In this example, the upper wick example here, the market opened with the buyers immediately taking control, forcing the price higher and overcoming the sellers who are compelled to admit defeat under the buying pressure. However, as the session or candle developed, the price action reaches a point at which the buyers are beginning to struggle. The market is becoming resistant to higher prices, and gradually the sellers begin to regain control. Finally, at the high of the session or candle, the buyer runs out of steam, and as the seller comes into the market, the buyer closes out their profits. The selling pressure then forces prices lower as waves of sellers hit the price action. The candle closes back at the opening price and the session closes. Once again, there are two key points with this price behavior which are fundamental. First, we have a complete reversal in market sentiment, this time from bullish to bearish. Second, the sentiment at the close is bearish, as the opening and closing prices are the same. Now, this is a visual depiction of the price behavior. Now, nevertheless, this is what has happened over the session or the candle, and it makes no difference as to what frame we are considering. Now, as I said, it doesn't work as well in short time frames. We really need longer time frames, at least 5 minutes, to really see how price action is moving, whether the bears or the bulls are winning. And this, second, the sentiment at the close is bearish, and the open and closing price are the same. Now, this is a visual depiction of the price behavior. Nevertheless, this is what happens over the session or the candle, and makes no difference as to what time frame we are considering. This could be a candle on a tick chart, a 5-minute chart, a daily chart, a weekly chart, and this is where the concept of time comes into play. This type of price action, accompanied by the correct volume profile, is going to have a significant effect on price, whether seen on a 1-minute or 5-minute or greater chart. And again, I think we start from a 5-minute chart for the best results. Okay, this is a lower wick example. We have a wick where the price is open. The market has moved lower, then recovered to close back at the opening price. In the lower wick example, which is this, the reverse of the above higher wick example above is also true. So what's the conclusion here? The upper and lower examples are extremely important price patterns. Although the resulting candles don't look terribly exciting on their own, they actually represent one of the most powerful price actions that you'll find on any chart, particularly when volume analysis is added to it. Price action and volume then tell us where the market is likely to go next. As traders, we really need to be able to visualize the buying and selling simply from the price action of the wick on the candle. But of course, what this does not reveal is the strength of this price action, and perhaps even more importantly, whether this price action is valid. Is the price action genuine or is it false? And if it is genuine, what is the strength? This is why price action trading only tells half the story. It is volume which completes the picture. And that is our quick lesson on wick examples. Here's the resources, a complete guide to volume price analysis by Anna Calling. You can also get a lot of this information from annacalling.com. Also, take a look at quantumtrading.com and quantumtradingeducation.com for more information on how this works. Now, we're just taking this in very small chunks as we go along. Okay, that's it. Is there any questions? Anybody have any questions on that? I know I went through it pretty quickly. If you have the book, I really would love you to go and read chapter 3, read through the chapters. There's more information in the chapters, but this gives you a quick overview of what we're looking for in terms of the individual candles and how they open and close.
Tim, Keith here. Certainly, those last couple examples are what we see pretty much day in and day out of the chart when it's trying to change direction and then gets pushed back. So like on that one, it tried to go down and said, nope. The buyers came in and said, nope, not going to do that. And it pulled right back. That's why a lot of times we don't trade right at the beginning of a new candle on the 1 minute candle because we're waiting to see what's happening on that wick as to whether it's actually getting pushed back or not.
Yeah, good point. Yeah, absolutely. We do, as we go through this, we want to see how the price action or the how the price analysis, not price action, but also price action, but price analysis, we need to see it develop over a bit. And 5 minute candles work pretty well for this, 5 minute or longer. But that's a good point. Thank you for that, Keith.
Yep.
So the length of the wick, it seems to me that it's almost I don't know how to say this, but in moderation, it's good. If it's too long, you're starting to get into dangerous territory.
Yes, that's true. But notice in this example how the wick came down, but the spread started and ended almost in the same place. But the longer that wick goes until, let's say it's a lower wick example here, the lower that goes, the more buying power is going to have to come in, or selling is going to have to exhaust before buyers come back in. And we can see that in what just happened in the market. Let me get out of here and let me bring up right here on the 5 minute candle. This is a great example of sellers have been dominating the market since we got into that call trade until it reached a point where it reached exhaustion here. And if we went out to a longer look at these candles, we would see that if we were in an hour long or 2 hour long candles, we would see how that wick came way down. The spread came way down, but started retreating as soon as the sellers started getting exhausted here. And it looks like we've come up, we had a little bit more sell-off, and it looks like we're recovering back again toward the call side. Showing, and what this is showing is that there is, after this long sell-off and pretty good climb, we have really short exhaustion on both sides of these candles now. and probably will for a while, if not the rest of the hour.
The other thing to keep in mind also is if a lot of times we're looking at the 1 minute charts, the 5 minute chart may be when you first get a new candle, if you tend to get a strong move right at the beginning of that 5 minute candle, the spread or the height of that body of the candle may be misleading because again, you haven't averaged over 5 minutes yet. You're just over the first 30 seconds of a 5 minute candle. So you got to be a little careful in saying, oh man, we got a strong move up there on that. Well, let's wait and see on that because it can be misleading on that on the beginning of a candle.
Mm-hmm. Yeah, absolutely. Anybody, any other comments or questions?
Thank you.
Thank you. And thank you again, Brian, for those great illustrations, great chart or candle illustrations. I appreciate
Yes, thank you, Brian.
appreciate you building those out. Absolutely. All right. Well, if there's nothing else, we'll go ahead and end this. Let me just